What's up, everybody? According to Mark Fleming, the chief economist at First American, a Fortune 500 company, home price appreciation is a thing of the past. In the First American Data and Analytics Home Price Index report, home prices reached a new peak for the 10th month in a row in January of this year. The report shows that home prices in January of 2024 were 7.2% higher than the year before. But it also shows that the peak appreciation may be behind us. So today we're going to take a look at an article by Sydney Lake for Fortune titled, "Say Goodbye to the Peak of Home Price Appreciation, Fortune 500 Chief Economist Says It's Behind Us," to see why Fleming thinks we're in for such a big change. So let's dive right in. One of the reasons Fleming thinks that home price appreciation is behind us is that he thinks that mortgage rates are on the way down. With lower rates, sellers who have been locked in to their super low mortgage interest rate will start to ease and put their homes on the market, creating more supply. The expected lower mortgage rates this year will obviously help buyers by improving their home purchasing power, but it also reduces the financial cost of the rate lock-in effect, says Fleming. Lake writes that the current 30-year fixed mortgage rate is about 7.13%, according to Mortgage News Daily, lower than the 8% peak in October of 2023. Economists and other housing experts are torn on the mortgage rate outlooks for the year, but generally speaking, most expect rates to fall between the 5.5 and the 7% range, which is still considerably higher than the rates during the pandemic. The pace of annualized home price appreciation peaked in December as buyers rushed to take advantage of falling mortgage rates, Fleming wrote in his January 2024 report. In January, the preliminary estimate of annualized appreciation cooled modestly by 0.5% and is likely to slow down further in the coming months. Now, don't misunderstand. He is not necessarily saying that home prices are going to go down. In fact, Fleming says that First American tracks 30 major housing markets, and none of them are experiencing home price drops like they were a year ago. He is simply saying that home prices will not appreciate as much as they have been. More supply this year is unlikely to cause outright price declines, just slower appreciation, Fleming says. However, the expected moderation in the pace of home price appreciation due to lower mortgage rates in 2024 will be good for potential home buyers, as it was harder for home buying power to keep up with home price appreciation last year. One thing that I think Fleming and a lot of these industry insiders are forgetting is that homeowners are staying in their homes for a lot longer than they used to, specifically boomers. In a Redfin article by Dana Anderson titled, "Homeowners today stay in their homes twice as long as they did in 2005, driven largely by older Americans aging in place." She cites that the typical U.S. homeowner stays in their home for 11.9 years, up from 6.5 years 2 decades ago. In addition, nearly 40% of baby boomers have lived in their homes for at least 20 years, and another 16% have lived in their homes for 10 to 19 years. For Gen Xers, more than 1/3, 35%, have lived in their homes for at least 10 years. More people staying in their homes longer contributes to the inventory shortage, which has nothing to do with interest rates. Well, let me rephrase that. Boomers could be staying in their homes because it's too expensive to move, or it could simply be their preference, or the fact that we just live longer than we used to. Regardless, people staying in their homes longer contributes to the lack of inventory and pushes home prices higher. A recent Redfin analysis shows that empty nest baby boomers own twice as many 3-bedroom plus homes as millennials with kids. This could be because millennials prefer renting, but most likely because there just are not enough homes to buy. And the cost of buying a home, especially for first-time buyers, has become unaffordable. The Redfin analysis shows that home buyers stay put the longest in California, 18.7 years, partly because they're incentivized to do so by Proposition 13. And homeowners move most often in relatively affordable metros, mostly in the South. The shortest tenure is in Louisville, Kentucky, which was 7.4 years. But back to Fleming. Taking a look at the January 2023 to January 2024 home price growth, all 30 major housing markets, as tracked by First American, had home price increases higher than the national average. While house prices increased in all 30 markets tracked by our index over the last year, this rising tide hides the change in market prices since their peak, Fleming wrote in the report. Measuring the price change in each market from their post-pandemic peak reveals that house prices are below their prior peaks in 23 of the top 30 markets. Fleming continues by saying that if more sellers are willing to sell, more supply will create less upward pressure on home prices. The article ends with a comparison of today's market to that of the 1980s. Both periods featured high inflation, rising interest rates, and a boom of home buyers coming of age. These three factors, Fleming wrote in an October 2023 report, could create a housing market recession similar to that of the 1980s, a time period when home sales stay low in a frozen, unaffordable market. The difference is that home prices declined in the 1980s, whereas today it seems to continue to go up, even if only slightly. When the Fed started to reduce rates after tackling inflation in the early 1980s, house price appreciation declined nationally very modestly. Now, because supply has been so constrained, house price appreciation has been very strong and is expected to continue to remain positive as the Fed begins to lower rates, Fleming says. So once again, it seems like inventory is the answer to our housing affordability crisis. In Redfin's latest housing market update for the 4 weeks ending February 18th, new listings rose 10% year over year, the biggest increase in 2 months. The metros with the biggest increases in new listings are Jacksonville, Florida, up 33.5%, and Dallas, Texas, up 33%. The metros with the biggest decrease in new listings are Cleveland, Ohio, down 25.3%, and Atlanta, down 13.3%. Active listings are still down nationally by 1.8%. The median sale price is up 5.8% year over year, the biggest increase since October of 2022. Metros with the biggest year-over-year median sale price increase are San Diego, up 15%, Newark, New Jersey, up 14.3%, and Anaheim, California, up 13.5%. The metros with the biggest year-over-year median sale price decrease are San Antonio, Texas, down 4.1%, Austin, Texas, down 0.4%, and Fort Worth, Texas, down 0.3%. It's interesting that they're all in Texas, and honestly, they're not down by that much. Pending sales are still down 6.7% year over year. 36.5% of the homes still sold in the first 2 weeks, up from 35% a year ago. The median days on the market are 50 days, down from 52 days a year ago. 22.9% of the homes sold above their list price, up from 21% a year ago. And 5.7% of the homes for sale did have a price drop, up 1.4 points from a year ago. The data shows us that most of our country is still experiencing a seller's market due to the lack of inventory. But as we know, real estate is very localized, so what's happening in one part of the country can be very different than what's happening where you live. But I do think we can all agree that with more inventory, there'll be less competition for good houses, and by good houses, I mean those that are priced right and show well, which could calm home prices down. If you missed last week's video on how investors are buying the most affordable housing, therefore creating more renters and controlling the uptick in rent prices, definitely check that one out next. Thanks for watching. I do appreciate it. Bye.